Welcome, everybody, to the Real Estate Investment Education Club. My name is Daniel Homland. This is a weekly educational club that is part of Intel's employee resource organization, hosted by the Next Gen Professionals Network. And we are proud to bring to you investment and real estate investment speakers from different areas around the country that speak on topics that they know well. So, first of all, welcome to the club. This club is meant to empower you to be a great real estate investor and to learn and to educate yourself in real estate investment techniques. We talk about everything from single family rentals to note investing, Airbnb, commercial real estate, property management, and any other topic that relates to real estate investment. We also want this to be a forum where people come together and share their interests and their dreams and their goals about real estate. So, to that end, I want to announce that if you want to subscribe or unsubscribe to this, go to meetup.intel.com and look for REIC. You'll be able to either follow or unfollow all future events there. Also, every second Tuesday, every second and fourth Tuesdays from 11:30 to noon Pacific time, we have an informal real estate discussion group. And this group is really focused on people coming in with questions and just wanting to discuss ideas. It's extremely low key, there's no agenda, and it's just a good lunchtime break for people. Also, if you'd like, you can go to soco.intel.com, to this particular link, which is on Inside Blue if you search for Real Estate Investment Club, and you can view past episodes that we've recorded. So we have recordings there from people who have spoke on short-term rentals, such as Airbnb. Another Intel employee came in and shared with us about his note investing business. People have been talking about all sorts of different topics. Last week, we had a group in that does syndications of farmlands in Colombia and is very interested in foreign agricultural investment. So there's all sorts of topics that are here. You can join us on Yammer. We have a discussion group at web.yammer.com. Search for Real Estate Investment Club. And we're also looking for people to join our leadership team, which is involved with finding guest speakers, helping to vet the presentations to be sure that they're HR compliant and that they are within Intel's guidelines, and also sending out the meeting updates and messages on Inside Blue. And so without any more ado, I'd like to introduce Whitney Su. Whitney Su is a founder and partner in LifeBridge Capital, and he is involved in multifamily real estate syndication. Whitney, I'll turn it over to you.
Awesome, Daniel. Thank you so much. I'm grateful to be here, very much so. Let me go ahead and share my screen. I'm probably not as tech savvy as most of you, but is that working, Daniel?
I can see it.
Great. Appreciate that. So again, Daniel, I'm grateful for the opportunity to be here with each of you, and looking forward to this. Looking forward to connecting with a lot of you and helping any way I can. But ultimately today, I want to share numerous things with you. And I'm grateful for your time, respect your time. I know how valuable your time is, and I'm grateful to have a few minutes of it today. So I want to add a lot of value to you, and I want to educate you as much as we can over just a few minutes. But tell you, I want to go into a little bit of my story and how I got here, how I got where I'm at. But I want to help you to understand just some key things about the benefits of real estate syndication and really some common myths and red flags for passive investors that a lot of people don't know when they're getting into the syndication business, passive or actively, but specifically when you're a passive investor. So just some things I'd like to highlight. Remember, you can text Whitney to 66866, and you can see a lot more of this information in more detail. We'll send you a report that goes in a lot more detail than we can cover today. But to get right to it, I want to share some of my story, and because I think it's helpful in how I got where I'm at, and will probably help you as well, I hope, and that's my goal. And otherwise, anyway, you just get to know me a little better, and hopefully we begin a relationship. So In March of 2001, and I say March because at that time things were a lot different than say September and October of that year, if you can remember what happened on 9/11. And so, but at that time, I decided to join the military, and I just knew that it was the right thing to do. And of course, though, I had no idea that in just a few months, our nation would be at war, and pretty quickly that I would find myself spending a year of my life in Iraq, toting around a machine gun, praying every day that I get to go home. And unfortunately, not everyone in my squad made it home. But one thing that the military taught me though was to have a never give up mentality, and that kept me going when lives were on the line. And by the way, in case you're curious, I made it home alive. Thank the Lord. Um, so, quickly though, coming home, I had to figure out what I was going to do, right? What my career path was going to be. I'm sure a lot of you were in those shoes at one time. But I came home, and obviously I enjoyed the structure and the discipline from being in the military and the uniform. And law enforcement was a great path for me, and so I quickly pursued a career in law enforcement. And out of 1,200 applicants, there were only 5 positions, and I was blessed to have one of those with Kentucky State Police. And so that never give up mentality still had to be something that I had every day, and it had to show from the way I wore my uniform to the way that I responded to every dispatch. And so it was at that time, though, that after a couple of years of law enforcement, I got married, and it finally hit me that we just passed each other in the hallway the first whole year of marriage, and it also hit me that making around $30,000 a year, just it was going to be difficult to support a family. And while I enjoyed working the road as a police officer and would have done it for free the first year or so if I could have, it just wasn't what was best long term. And so that pushed me into looking for other ways to supplement my income, and then in came real estate. And so I was exposed to real estate at that time where I was searching. I had no idea about the syndication business or the possibilities of that, but we'll get to that in a minute. But I did jump into real estate lightly and learned a lot the hard way, which we'll talk about. But at the same time, I became a federal agent. And so it's a lot of law enforcement's, dream career path is to go, say, from state police to becoming a federal agent. So grateful to have done that. And so becoming a federal agent took, though, Chelsea, my wife, and I to Virginia. And so that's where we still live now. All right. But that never give up mentality has just paid off in a big way to where we're at now. So behind this picture that you see now, you see a triplex, and that was the first property that we purchased. That was in 2009. And of all times, we still paid too much for this property. We didn't know what we were doing, but I just knew that if so many people had made wealth in real estate, that I could too. We learned, like I said, so much the hard way, but ultimately, after moving to Virginia and looking for more rentals, we had sold these and buying more. We got up to like a 15 unit at that time, but we were tired of looking for more tenants and toilets, honestly. And when I started thinking about, how many doors is it going to take me to supplement or replace my income, that was going to take a long time. I mean, it was going to take a long time. And so eventually I was introduced to the syndication business. I could not believe that I had known about this so many years earlier. So like I said, I enjoyed the structure and discipline and from previous training, and I knew that this was a business model that I could scale. And so with what I already knew about real estate by this time and what I was learning about the syndication business, we jumped in completely. We sold everything to make it happen and just be completely focused on this business. And so I'll explain a little more about syndication in just a minute and some things you need to know about it. So pretty quickly, or I will say about a couple of years ago now, I started a daily podcast called the Real Estate Syndication Show. And it's every day, 7 days a week. But I've interviewed over 600 industry experts. And so that podcast has given me rapid credibility, exposure, results. My network of investors and industry leaders exploded. And so this was my own university. It cost as much as a university as well, but it allowed me to ask any questions of the experts that I had at that time. And so it's paid so much forward just because of the education component alone, but also just from the networking piece of it. But that podcast has got me on many stages, including on talks just like this. So obviously you can find that podcast at lifebridgecapital.com or YouTube or on any podcast player, but we cover every topic around the syndication business you can think of. So while we're very excited about our growth, of our business, something else I want to tell you is just about what's behind that growth. And so one day, my wife Chelsea and I, we were listening to a pastor talk about how they had adopted a child and how there are over 160 million orphans in the world. So that's nearly half the size of the U.S. population, if you can just imagine that for a moment. That many orphans in the world. Okay, and they're dying of things like diarrhea and things we can cure with $1. And so and it also it's so unfortunate combination here that it can cost $40,000 to $60,000 to bring a child home through adoption. And so you'll see where I'm going, how this is getting to real estate in a minute, but it's just important that you understand our why. I want you to know our why and our mission behind what we're doing. It's important you have a why and a mission behind what you're doing as well. But at that time, my wife Chelsea and I, we'd only been married a few years. We had never discussed adopting before. But on our way home from listening to that pastor talk about that, we immediately asked ourselves, why would we not adopt? We could not think of a good reason why we wouldn't adopt. And so 2 years later, our first son, Samuel, came home from Ethiopia. Actually, within 5 days of us talking about that, we turned in an application to adopt from Ethiopia. And it took 2 years before our first son, Samuel, came home. A year later, our second son, Elijah, came home through adoption as well. And just a few months ago, our daughter, Eden Joy's adoption became final. So my wife and I are now on a mission to help other families through the process of adoption. And obviously, this quickly became our why behind LifeBridge Capital. The LifeBridge Capital, or myself personally, we've committed half of our profits to helping families with the financial burden of adoption. And so often we take calls with couples that are wanting to adopt and want to ask about our experience. And, when they ask about how much, they should look for the expense, and we mentioned 40 to 60,000, that usually halts most of them in their tracks. And it's so unfortunate because they'd be great parents, but their expression is, well, that's more than I make in a year. And so, that's where we want to be able to come along beside them and say, if you'll commit to adopting, we'll commit to helping you. So we've partnered with our church and other nonprofits in the past, and we're in the process now of starting our own nonprofit so we can streamline that a lot more. So that's our why, and obviously something we're very passionate about, and you can see our family on the screen. So after interviewing hundreds of experts, I recognized a pattern, and I recognized that people that had a business partner usually had rapid results, or people that had rapid results had a business partner most of the time. And my wife, Chelsea, and I had been praying for a partner for a long time. And I'd been asked by many people to partner, and I'd turned them down. And I treated this decision just like a marriage. I did not want to make a mistake and lose all the investors' trust that I'd worked so hard to gain. So at conferences, and I networked and had meetings and meals with as many people as possible. And at a large table one night, I heard a guy talking about his faith, his family, how much he had accomplished in the syndication business. And in a very short period of time, I could tell that he was someone that was as motivated as I was. And from our discussion, I could tell he had complementary skills and a lot in common. So the last night of the conference, I told him that I'd been looking for the right business partner, and that he seemed to fit the bill. He was very excited, and we began a very fruitful relationship. So his name is Sam Russ, and Sam and I have been able to accomplish so much more by working together than I ever could have on my own. And actually that photo is a property we just closed in March, just a couple days before the country shut down, actually. So, but it's been great. It is going very well, to say the least. So let's jump into a few things about the syndication business and just some things that you need to know about. but obviously we're going to be focused on passive income generated by commercial real estate and investing in the syndication model. So when we're talking about these things. And so, as I have conversations with investors almost on a daily basis, I'm always surprised at how many don't know what passive income is, or that it's even an option for them that they could invest passively in real estate. And so I know a lot of you, a couple of things here may be a review, and I hope so. I hope that you are savvy about investing in a real estate syndication. But in case some of you are not, I'm going to cover just a few basic things that you definitely need to know. And so, obviously, passive income, it does sound like just sounds too good to be true to most people. And there's some people that would say, well, there's no such thing as passive income because you do have to do something. Well, and that's true to some extent. But this is about as passive as it gets as far as what I've found in real estate. And so, investing in a deal like this, you're gaining that reliable month-to-month income with almost no effort. Once you've vetted the operator and the deal and you've made that commitment, ultimately you get our updates once a month and a distribution. But it also allows you to have multiple streams of income, which, and actually this model, I think entrepreneur.com, it's like two or three of the top 10 things that the most wealthy do. This model takes care of numerous of those things. So just, passive income, just be thinking that way, and how can I create passive income? So, I can have more time with the family or whatever your goals are. But, the syndication, like I say that word or talk about the podcast, people are like, well, what in the world is real estate syndication? What does that mean? And most of these things are more simple than it seems. But it's really just pulling investments from lots of people together. Pulling capital together so we can purchase, say, a large investment property that would normally be inaccessible to most investors or most people. We would normally, most people would not be able to purchase, say, a $30 million property on their own. However, they can invest passively and gain most of the same benefits as investing, let's say, if they bought a single family rental, and ultimately a lot more passive than that. A couple of things. I'm no tax expert, but I wanted to share a couple of things with you. And some of these things I want you to know just as you're talking to operators, as you are talking to an operator, that you know what questions to ask, or if they mention different things, I want you to have seen it before. But depreciation, most people have heard of like straight line depreciation, maybe the most common form, but it's going to deduct, equal amounts of the property each year, normally like over 27 and a half years. Okay. They're going to assume the life of the property is going to last that long. But in the syndication business, we can do what's called a cost segregation. Okay. And this allows operators to have that deduction within, say, up to 15 years sometimes, but sometimes we can do it within 5 years. We can have those same deductions instead of waiting 27 and a half years. Okay, so we hire a specialist that comes in and completes what we call a cost segregation study, and they do all the calculations. And this allows us to depreciate every piece of that property individually instead of depreciating it as a whole. So the tax benefits are then passed along to investors who often show a loss in the first year, even though they've received income, for the first year and then longer as well. So, again, I encourage you to talk to your CPA and make sure, the tax benefits and things like that will apply to you specifically. So there's also different asset classes. There's lots of different commercial real estate to think about when you're debating about, okay, should I invest in this type of property or that type of property? There's just a lot to consider. And so one thing you want to consider is obviously the risk involved, right? But different types of property that you invest in are going to have different types of risk. And so just a few things I laid out here for you is just thinking about, okay, do I want to invest in a new development deal, a value add deal, or a distressed deal? And then we could, you could go into tons of different asset classes like mobile home parks or self-storage or multifamily or medical or retail. There's tons of different types of properties and investments, or Class A versus Class C, like the nicest properties in the nicest part of town, which would be your Class A, versus maybe the C minus or D properties where you might need a bulletproof vest to collect your rent, right? So, But just going through a few things here, just to help you be thinking about these things as you're seeking out an investment that fits your criteria. Like a new development deal, it's generally going to have a higher risk of investment, and just no guarantee of long-term rewards. Of course, no investment has a guarantee, but this is going to be a higher risk. And you may not make money from that project, till they exit the deal, meaning till they sell it, or 2 years later, or depending on what the business plan is. So, they have to build a property, and then they have to find the tenants and lease it and different things before they actually have any cash flow. So, you just have to understand that there could be a higher return on your investment. It's very potential that you could have a larger return. However, you may have no return for a few years, and you just need to know that and the risk, and make sure you're up for that kind of risk. So value add is really the type of investment that our team focuses on and have focused on for a while. And so it's really, the property already exists, okay, but the problem, there's a problem with the property that needs to be fixed, okay, in order for it to have better revenue or stable revenue. But perhaps it's just like outdated or mismanaged, or it needs better marketing, things like that, to attract better residents. And that's the typical scenario that we would normally look for. But these properties also, are going to be what we would call stable, usually from day one, meaning they have like 80 to 90% occupancy. They're not, half occupied or anything like that. And so they're typically cash flowing from day one. And we just feel like these are much more stable, just a much less risk investment. And so that's why we really like these types of investments. We're not having to build a building, but we can easily put in new management. We've done this numerous times now. But it's going to involve, extensive research, right? And, great property management, from your sponsor, which would be me, or an operator, but you have to consider things like the property age and location and footage and so forth for, when you're doing that analysis. But so, another type of a property that can give you a very higher return could be a distressed property. So, or it's just unstable. Okay. The property could have, it could need large amounts of renovation, but you still have to remember that it could be high risk. It could be a delay in distributions, or, you getting paid, things like that. But it could have a higher return, but there is higher risk. Okay. So just a few things to think about. We could talk about those, probably for the whole time, but just so you can understand some different types of properties. So if somebody presents a property, you can be thinking through their business plan and thinking through, okay, what all has to be done here to make these projections happen? How much are we counting on all these factors? How many factors is there? Am I okay with that much risk? Okay. So let's go into returns a little bit. You're probably wondering about returns. Everybody wants to know about returns. Daniel, can you still hear me? I just wanted to check in.
I can hear you. Yes.
Great. Okay. So I just I want to jump into returns, and because obviously everybody wants to, you need to understand what's being projected, and what that sponsor or that operator, like myself or anybody that's operating a deal, can, or is telling you that you're going to get. And, first, obviously we know that no investment is guaranteed. However, doing proper due diligence, we can, mitigate as much risk as possible. So a preferred return ultimately means that you're getting that much, whatever it is. Typically we do an 8% preferred return most of the time. Every deal could be different, or every operator structure these things differently. But one thing you need to know is that it's the first 8% of any cash flow. So if there's no cash flow, there's no preferred return. And it's a big misconception in our business, or amongst investors. And you just need to understand that there has to be cash flow for there to be that preferred return. Okay. And so we've never missed a preferred return payment, and we never plan to. But you just need to understand that that's where it comes from. So if there's no cash flow, there's no preferred return. But it does mean that you're getting the first cash flow. So before anybody else is paid, our limited partners, who are the passive investors, are getting the first cash flow. You just and we'll talk about some other documents and things now where you'll confirm that that's the way it's structured. And if it's not, I would probably walk away. So after a preferred return, Okay, then there's normally what we call a split or cash flow split, and that's going to be between the operators or the syndicators and the limited partners who are the passive investors. So no, like when somebody says operator or syndicator, that's also, it could be called the general partnership team. That's kind of all the same people. Those are the people who are active in the deal. Okay, they're the active operators. That's the general partnership side, and then there's the limited partners who are the passive investors. Okay, but that could range, big from say 50-50 to 90-10, anywhere in between or above or below that. I just like for investors to know that, that split could vary, and it should vary depending on really the risk that's involved for you, the passive investor. All right. So, the higher percentage is going to go to the investor. And so, if it's a 70-30 split, which is very common, that's what we've done a lot of the time, is a 70-30 split. So then you would receive that 8% preferred return. Then everything after that would be split 70-30, 70 going to limited partners, 30% going to the general partnership team or the active side. Okay. So then to bring up something that's usually extremely or made to be so complicated, but try to tame this down a little bit, because it's not that complicated. And especially, when thinking about how the returns are structured, you just need to understand what we call a waterfall structure. And it's usually, or let's say, if you can imagine just a cash flow, pulling up, and as soon as it starts to overflow, the waterfall structure really tells it where to go. Okay, it tells that additional cash flow above the 8% where to go, right? And so we already know, let's say we have a 70-30 split, like I talked about earlier. Well, that may happen up to what we call a hurdle, or for example, let's say an investor, we say it's going to happen at a 15% return. Okay, so you get that 8%, and then it splits 70-30. Okay, but then as soon as the investor makes, let's say, a 15% return, there may be a hurdle there, or a waterfall that we call it. So then it may split again and then go down to, say, 50-50. Okay, sometimes that's at 20%, sometimes it's at 13%. I've seen it all over the place from different operators. But you just have to know, you have to understand the risk involved. Okay, and then you just need to know where that's at. Most investors are thrilled to get 50% after 20% of a return. I mean, it's kind of a no-brainer still, but you just need to understand that, that helps motivate the operators to operate the best that they can too, which I hope they are anyway. But they also know that once they get above that 15 or 20%, whatever that hurdle is, that they're going to get paid a little more. Okay, so just understand that that's what a waterfall structure is, and you can ask an operator, is there a waterfall, or how's the return structured? Okay, so when you're just talking to an operator, how do they commonly do that? So let's see, yeah. So just know, like that 8%, it's got to be filled before any others are filled. Then it goes to the 70-30, and then it would go on down, filling one pool after the other. So a new thing in the industry that's very new, actually, I would say in the last year or two, a couple of years, is called a dual class structure. And it's a pretty cool option for a lot of investors. I was kind of taken back when I first seen this. I thought, wow, I've seen some other operators doing this, and I just want you to be familiar with it and know that this option is out there. And so having a dual class structure, and I'll go into what that means a little bit more in a minute, but it gives you two options. It allows you to have, say, a bigger preferred return throughout the life of the deal. Okay, but then you don't get any upside, meaning if the property sells, say, for a lot more money and the returns are greater than they ever expected, you don't get any of that. Okay, however, you did receive a higher preferred return throughout the life of the deal. Sometimes it could be 10, 11%, which is great, right? But and some people would say, that's where I want to be. I'm fine with that. And they consider it less risk, and I'll cover that in just a minute as well. But then there'll be what we would call a Class B investor that may get a lower preferred return, but they do get more of the upside. Okay, so if there's extra cash flow that's paid out to investors, let's say there's a refinance, or there's something that happens where there's a lot more cash flow in year 2 or year 3, but especially when they exit or sell the property, that Class B investor is going to get that split of their part of that upside of the deal, like we talked about earlier. Okay, and then the Class C operator would be the operators or syndicators or the general partnership side. Okay. And it's important to understand like where you're at and in that, and because we call that the capital stack. Okay. And so it's important to know where you're at in that capital stack. And because ultimately the higher you are in the stack, typically means you're paid first. Okay. So and it could mean that you receive the highest returns with less risk, as far as the preferred return is considered. Okay, maybe not over the life of the deal, but throughout, including selling it. But at least initially, that's what you would get. So just that's a new thing now. A lot of people don't understand. Like, well, why would I pick one or the other? And I think you just have to think about: do I want more cash flow now? Am I okay with a little more risk, or do I want just that solid cash flow, or do I really want to wait out for more of an upside later? Okay. So it's important to understand, are you an accredited investor? And most people don't know, and it's pretty simple, but it's important to know, and I'll tell you why in just a minute as well. But accredited investors are going to have an annual income of $200,000 by themselves, or $300,000 jointly with a spouse, and they've typically had that income for at least the last 2 years. Okay, or they can have a net worth of at least $1 million. Okay, that's an accredited investor. A non-accredited investor is obviously not going to meet the definition of an accredited investor, but know also that a non-accredited investor is often called a sophisticated investor. But they have knowledge, they have experience with investing, and they've invested before, and typically they understand the risk. They're capable of determining the risk of an investment. Okay, and so that's what we're doing a lot of times when you're on an investor call. I'm trying to ensure that you understand the risk and that this is a good fit for you. Okay, the last thing I want you to do is to invest with me or with anybody else, and it's just not what you thought, or you feel like you didn't understand everything you needed to know about investing in these types of deals. So, but also know that depending on the type of deal, okay, that an investor or an operator is running, they'll only be allowed to have up to 35 non-accredited investors, okay, or they'll not be able to have any at all. Okay, so and we won't go into a lot of detail here, but let's say if it's a 506, what's called a 506B offering, B as in boy, okay, they'll be able to have up to 35 non-accredited investors, and then all the rest have to be accredited. So then it's first come, first serve. So if you're not accredited, you got to jump on there pretty quick, okay? Because ours fill up really fast, especially for the non-accredited. But either way, so you gotta jump in pretty quick if you're non-accredited. So, but if it's a 506C offering, then it's for only accredited investors, and the operator has to go through a verification process to verify you're accredited. Okay, so just know that that's coming up one way or the other. Just understand, know if it's a 506B or C. Know that if it's 506B, they cannot advertise, and they have to have a pre-existing relationship with you, meaning they've had to have talked to you before a couple times, or at least communicated with you some to understand that you know the risk and you have some type of relationship. Okay, and that's a 506B, which is most common. Okay, but then 506C is becoming more common, but not near as much as 506B. So 506C, they can blast it from the rooftops. 506B, they cannot advertise in any way, form, or fashion unless you already have a relationship. So I wish I could take a poll right now, but I want you to ask yourself, if you had to answer, is the deal or the operator the most important? When you're thinking about investing in a syndication, which is most important? And personally, I always say that the operator is more important than the deal itself. I mean, the property is so important, the location, and there's so many factors that are extremely important. But I still feel that those are second to the operator. Okay, and when you're investing, personally, I just feel like you're investing in the operator so much more than you're investing in the property itself. And so if you're thinking about investing, that operator is the one that you're trusting to know the ins and outs of that property and the market and his ability. But even more than that, things happen. Things have to be changed. Strategies have to be changed or fixed, or, things happen that are unexpected. And you want to ensure that you're working with somebody that's honest and that's really going to communicate well with you and tell you what you need to know. They need to come out and tell you this is why we're making specific decisions. And if you can't trust that individual, it doesn't matter how good the deal is, you better walk away.
So Whitney, I
Yes.
know at the end you were going to leave time for questions, and I know that you still have more material to do, but I just wanted to break in to let you know that we do have some questions that have queued up, and I want to encourage other people to submit their questions as well. And whatever Whitney says, we'll start going through them.
Awesome. Yeah, I think I just have a few more slides, and we'll try to get through as many questions as we can. Um, so you've heard you've heard the phrase, don't put all your eggs in one basket. And that still applies here. And I'll try to speed up Daniel a little bit so that way we for sure have time to get through as many questions as we can. But don't put all your investments obviously in one basket. If I know how much capital somebody's looking to invest, I mean, obviously I'd love for them to invest it all with us, but I'm going to honestly encourage them to not, and so think about different deals or different operators, spread it out amongst at least a couple operators that you trust, and that are in different markets. So then you can even get different asset classes and different operators and different markets. So you're just becoming more diversified, just with two operators. But just think through that, and you may not be able to do that all at once, but a lot of times the minimum investment, I should have said this probably earlier, but is 50,000. And so that's pretty common. Sometimes it's 100 or 250,000, depending on the deal and the operator. But just know that, think about diversification when you're investing in some of these deals. So what is a PPM? Very important document that you need to be aware of. And it stands for Private Placement Memorandum, and you should ask for it. Okay. If an operator is doing a syndication, if he's completing syndication, he's going to have a PPM, and you need to get it. If they're not currently in a deal, let's say you and I talk and we're not currently in a deal, then I won't have obviously a PPM that we're working on right now, but I'll have PPMs for previous deals, and you should ask for one of those. Okay. And there's different things that you need to know, but if they can't provide you with one, then you need to run. Okay. If investors are investing in a deal and they are expecting a return, which obviously most are, then if they have no other role, okay, it's something to know. If they have no other role than investing and expecting a return, then this is a syndication. Okay, and there's lots of legal steps that need to take place here. So some operators will try to cut corners, cut costs, and really skimp on this, but it's not legal, and they're not syndicating if they can't provide you a PPM. So be sure to ask for that. That PPM is so important, and a lot of passive investors, sometimes when they're first getting started with operator, they may even hire their own SEC attorney or securities attorney or SEC. Securities Exchange Commission attorney to review that PPM, say before they invest. Okay, it's not mandatory, but it's just good to know as an limited partner, as a passive investor, that you have that option, that you could find your own attorney just to review that PPM to make sure it's in your best interest, because not all of them are. That's for sure. So, but it's going to disclose, the fees that the operator is going to charge and the structure of how the investors are going to get paid, such as preferred return or split or waterfall, or, all those things that we've already discussed that you need to know. Okay. Hopefully they've already disclosed all that, but I would encourage you to read, especially those portions. It protects not only the operators, but it protects you as well. And it details what's going to happen and when. Okay, so you need to know, okay, what happens if we miss a distribution? What happens? Are they going to do a capital call, or when does a capital call happen? Or, do I get that money when we exit the deal? Or all those things are laid out in the PPM, and it's not always obvious in the very beginning. So be sure to ask those questions. And we're going to go to many more questions in just a minute. So an operating agreement, another document that you need to ask for. That's shorter than the PPM, but very important. It's going to explain how the deal is going to be structured and operated. You're going to learn who has voting rights, okay, and who does not. You're going to get a sense of those classes of membership, kind of like we talked about, and just what the profit split's going to be. Can you visit the property? Most investors I find don't realize that it's even an option. Okay. And many investors, they never take us up on this opportunity or actually go to the property they're investing in, but I encourage it. And we welcome our investors to do that. A lot of times it's like 2 years later after they're just in the area for some reason. But we just put it out there. But it allows you to meet that operator in person and actually put your hands on that property and talk to the management company and just see firsthand the operator and just that you're investing in that solid asset in that property and that it's not anything bogus or something in the cloud. But it's not a must, but just something to keep in mind. So a few things that I definitely wanted to go through so you could think about. This may stir up some more questions as well. But just what should you ask the operator before investing? And there's tons of questions that we could list out here, but I've just thought through a few that I definitely want you to be aware of. Okay. So, you can ask for, let's say, previous information on previous deals. If they don't have a deal right now, even if they do, even if they have a deal right now and they're handing you all this nice, pretty information, ask for information on a previous deal. Say, go back 2 deals ago and say, tell me the last 2 deals you did and ask for the first, that first one. And so, ask for that information. They should be able to hand you that information. They should be able to hand you that PPM and that, how that deal was structured, and ask how that deal's doing. And did it go according to plan? And what were your projections? And is that what's happened? And, what are some things that come up that you didn't account for? But to also ask how they communicate. How they communicate is so important. We usually do a monthly update every month. A lot of times we'll do a call with each investor after, say, the first distribution or something like that. But we want to over communicate through this COVID stuff. There's been weeks we've sent out 2 updates in 1 week, and it's been almost weekly there for a little bit. And now it's slowed down a little bit, but it'll never be less than at least once a month. It's just so we're giving them current information, vacancies and occupancy, income, things that's happening at the property. Ask to see that recent PPM like we talked about. Tell me, ask about their team. Ask who is the decision maker. I just feel like it's important. Like when you're talking on the phone, you may not even be talking to the decision maker, or somebody that's in charge of that property. So ask, don't just assume that's who you're talking to. So ask them about their worst deal. Ask them also if they are personally investing in the deal. Most investors will ask me this, but not always. Okay. You want to know that the operators are investing alongside you. It just shows an alignment of interest. You want to know that they're committed to this deal as well and that they believe in it. Very important. Something else I like to know is how much do you have in reserves and how long will that last? Okay. On that deal you just seen a minute ago, we had $1.5 million in reserves from day one. Okay. And a lot of operators that I talked to said, oh, that's way too much. That lowers the returns when you do that and whatnot. And I interview people often, and they'll have a 200-unit property and have $200,000 in reserves. It just makes no sense to me because that can just be going in a hurry on a property that size. But believe it or not, 2 days later, the country shuts down, and us and our investors are still sleeping well because we know we can still fund it very easily if we had to. We haven't had to touch that. But if we did, that's what it's there for. So just another question for you to think about. All right, Daniel, let's do some questions.
All right. It's a good thing we're getting to this here because I just scrolled up and realized we have a lot more than I thought we had. So I'm going to start at the bottom. And they all came in as anonymous. So if this is your question, thank you for submitting it. Which cities do you see the most of the real estate opportunity growing?
Great question. Great question. And there's a lot of things you have to think about when you want to say, okay, what cities, do you see the most growth in? And I would say it goes back to the operator again. But, some cities that we personally are investing in is Colorado Springs and Boise are a couple markets that we're personally in the Rocky Mountain areas. But obviously, throughout Florida, Jacksonville and Orlando, and in between there's a corridor that's having lots of growth. Obviously, Dallas has had tons of growth over the last 10 years and still having lots of growth. But those are just a few markets. Obviously, the Carolinas as well have had lots of growth and are still growing very strong. But the Rocky Mountain areas, just a couple that I mentioned there, and even Salt Lake City is a few that we're personally focused on.
All right, next question. Is this similar to Fundrise and Realty Mogul?
Great question. And I think they would be more like a crowdfunding platform, which is, syndication is kind of a new thing. It hadn't been around forever. It kind of has been around forever, but it hadn't been legalized, kind of like the way it is now. And so something like that is, those platforms I think will allow you to invest smaller amounts of capital. And I'm not sure in those that you always know what you're investing in. Okay, it's going to be probably more like an open fund or blind fund a lot of the time, where you're investing in this fund. These are the projections that they say they're projecting and what they hope to get you, but they're going to take that capital and disperse it amongst say numerous properties. Where these properties of syndication, like we do, it's going to be a fund, but it's going to be property specific. So the exact property that you're investing in. Like I said, you can come and look at it and touch it and ask us questions about that specific deal and market.
Since the 8% is independent of the waterfall distribution, is information provided to investors on what the post-waterfall return will be?
Yes, great question. So we're going to tell you every projection, the 8% preferred return, then it may be like a 17% IRR, and then there may be a waterfall at 20%. And that's something we did recently. And so we're going to lay that out so you can understand the exact, what were the projections that we expect. So the 8% is going to be annualized and then monthly distributions. And then, annually we'll assess our cash flow, and then the excess cash flow we're going to distribute to investors. And then that's where that split's going to come into play as well. And then as soon as you reach that IRR, that internal rate of return, or that hurdle that we talked about, then there may be a waterfall, something like that.
How does your game plan change in a post-COVID world where there is going to be a lot of people working from home?
Great question. And so, we're looking at a property now that is more Class A type property. And so it wouldn't be as much, it wouldn't be the value add play. And some of that is because of the COVID stuff. We would consider this a property like this. So, we consider it even more safe investment. There's just not as much to do other than better management. But something like this, there's and actually the location that it's in too is so important, because we want to know our tenant base. And so we want to know where these people work, where they live. Like this specific property, we know that it's been 100% occupied through this whole thing, and all these people work. A lot of them work from home already, or they have jobs that have to go, or they're in the medical field or something like that. And so, those are some things that we're going to consider even a lot more heavily now. Is we immediately start taking polls of where all the tenants work, or the type of industries they're in, or who expects to lose their job. So it's just some things like that we're going to take into account. But obviously, property is not worth now what it was 2 months ago as far as purchasing, because the financing is so hard to get at the moment, and lenders have really put big restrictions there. So that's changed the game a lot as far as what we can even purchase. And so, just some things to think about there. What type of financing does an operator have? And is there, our underwriting has changed quite a bit, since a lot of this has happened. Let's say, this first year, we don't expect any growth. We're not underwriting any growth whatsoever. We still hope for it, but we're not counting on any in the first year, after something like this. So that's just a couple things to think about.
I like this question. It was submitted by Brian. What is the most common reason past investors stop investing in syndicated real estate?
That is a good question. I would say one of the most common is that they don't have any more capital to invest. That they or it's just maybe they got burned from an operator, in some way. They didn't do proper due diligence, or I've heard so many horror stories with any investment that can happen, of course, but or different types of investments. But ultimately, I think it's a lack of capital. I think a lot of people, once they get into investing in a real estate business like this, they can see the property. It's still there. Even if the market crashes, the property's still there. As long as we've prepared, like I said, with reserve budget and different things, we still own the property. And so it's not like, the stock market and it's just gone. We still own it. And so most people that start investing this way, it's either a part of their investment strategy, and so a lot of people, it's their whole investment strategy. And so then they're just continually growing that.
This question kind of dovetails into the previous one. How to select the right group to invest with? What are the red flags that I should look for?
Yeah, great question. And so I mentioned many questions that you should ask somebody earlier, but and let me just go back there. Or yeah, well, I didn't list them all out there, but things like asking about their previous deals, asking for referrals, even asking for about their team, making sure. Did you know that you can even do a credit check or background check on an operator if you just want to or have to or want to? I've heard of people doing that. I've never had an investor do it on me, but I'm open to that. You know, I don't have anything to hide. So, but a few things to think about is how many deals have they done? You know, who are they connected to? You know, who are their advisors? You know, have they really thought out their team? You know, our team has grown a lot, and so we're not a one-man show. And I would advise you not to, you know, probably invest with a one-man show. You know, that's trying to do everything. So think through some of that stuff. But ultimately, it doesn't take very long to do some Googling and find out a lot about somebody often. But that credit or background check, if you really want to go that far, is a way to find out a lot more about somebody. And, you know, a couple things you can think about too is like what kind of, how are they reaching their projections? You know, how aggressive are they being? So, you know, are they expecting a 5% rent growth or 7% rent growth, you know, for, you know, every year for the next 5 years? That's extremely aggressive. You know, and so that would immediately be a red flag to me. I mean, that's extremely aggressive. But you know, you need to understand a few things like that just to know that, oh, wait a minute, you know, this is probably not going to happen. You know, it's just so unlikely.
Okay, so we currently have 17 questions that are queued up. If we don't get to your question, I apologize for that. But there's a lot of good ones here. The next one is 1031 exchanges. How would that work if I have a current rental?
Yes, great.
I'm assuming they're exchanging into the syndication.
Yes, so it is possible. It's not done very often because there's many things that have to happen, as you probably know if you're asking that question, to make a 1031 happen. There's a lot of working pieces there, but we can do it. Actually, we can 1031 into a deal. It usually have to be bringing a pretty large sum of capital to make it worthwhile, because there's a lot of expense there on our part legally to make that work. And so it can be done. You'd have to connect with us, you know, and or that operator and make sure that just the timing is going to work out for your 1031 exchange. But you need to understand too that a lot of times these deals, they may have a 60-day close, but then they may have, you know, a 30-day extension or maybe even two 30-day extensions. You know, that's possible at times. And so you need to know, you know, you need to be thinking about that as you're thinking about the timeline to meet your 1031 deadlines. Okay, so it is possible, and that's just something you'd have an individual conversation about with that operator to ensure that they'll even do it. A lot of them will not; they won't even discuss it. But ultimately, if it's a sizable amount of capital, then it's definitely doable.
How easy is it to get out or withdraw in full or in part from the investment?
Great question. And it's not easy. We try to make it very clear up front that it's a last resort. Like, it's very difficult to make that happen. You know, there's times, you know, in the PPM is going to lay stuff like that out, and that's what you want to look at. You know, there's times where maybe we could find another investor that wanted to invest in that deal and could buy your shares or something like that. But ultimately, I want investors to know up front that, you know, your capital is in this deal for the life of this deal. So if it's 5-year hold, you know, you're getting paid throughout that time. However, you're not getting your return of capital until most likely the exit. Or if there's a big refinance in like year 2 or 3, which is really common in value add deals, you may be paid back all of your capital then. That's something I should have mentioned earlier. If you invested $100,000, let's say in year 2 we did a refinance and paid you $70,000. Well, that doesn't go towards your preferred return. I mean, that's returning your capital, but you're still earning returns on a $100,000 investment. That's another cool part of this type of investing. And so even if we do a large return like that, you're still making returns on the 100,000. But ultimately, you can't just call me or an operator and say, I need my money back. It's just not that easy.
I know you touched on this a little, but are the returns for passive investors fully taxable, or are some of the tax savings passed down somehow?
Great question. The tax savings are passed down. That's the big benefit. That's when we talk about like the cost segregation and being able to depreciate the property so quickly. That's why a lot of times passive investors can show, you know, zero or show a loss the first year when actually they've made income. But you need to know too that like the passive income or the passive losses will only deter the passive gains. Okay, so it's something you need to obviously talk to your CPA about, specifically about your situation, to understand how it's going to affect you personally.
It's an interesting question. For a first-time syndicator, how do I convince and answer my investors' questions? Okay,
Great question. And
go ahead.
that's usually by partnering with another group that's more experienced than you, or having a coach and studying yourself. And that's usually how a lot of people get started. Is then you're going to just learn a lot more and be better educated. And you're going to talk about that group's track record and what they've done, as opposed to yours that you have none. At that time, everybody has to get started somewhere. But that's usually how that happens. Answering those questions are difficult in the very beginning, and sometimes I still get questions that I can't answer, and I have to say, okay, I'm going to look that up myself because I need to know, and then I'll get back to you. So there's no way we could all know all of it.
This is an interesting question. Are losses shared by passive investors as well?
Are losses shared? Great question. And so I would say they could be. You need to know what your PPM says. But ultimately, and when you say losses, when I said that, I'm assuming that you meant like if we didn't cash flow, and all of a sudden, there's a lack of cash flow. Is that the way you took that, Daniel?
That's what I'm assuming.
Okay, so if that happened, then ultimately our team, we're going to give up our 30%, or we're going to give up our portion or whatever, to make sure that we meet the projections that we told you. But that's why you need to know a little about that PPM, and you got to look at it and ask those questions of that operator, because every deal is different. Every attorney will write these things a little differently, and you need to know what happens when there's a lack of cash flow. If that happens, what happens? When do I get that capital? Do I get it back? Because it's not always that way.
What are the main advantages of investing through syndication as opposed to buying a REIT?
Buying into a REIT.
Right.
Yes, and I think in this case that we talked about a little bit earlier, exactly what you're buying. Like, you can see the property, you have a relationship with the operator, and ultimately, I think the returns are better. And I'm not sure about REIT, how much tax benefits are passed along as well. I'm not investing in any REITs, but anyway, that's
All right.
that's about all I can answer towards that.
Here's another tax specific question. Do you ever use 3115s at the end of your deal to allow investors to move into a new deal without depreciation recapture?
Without depreciation recapture, so that's separate from a 1031. Is that correct?
Yeah.
Yeah. So I would say that's not common. I would say that's not common. We try to do 1031s, or have a 1031 available for investors to move into another deal. And so they don't capture that, or the taxes, the capital gains anyway. But that specifically, no.
Okay. Will I get a share? Will I get a share of equity when the investment is sold? For example, if you purchase at 10 million and sell at 16, will the investor get a share of the 6 million equity at the percentage of contribution that they invested in at the beginning?
Yes, that's correct. You do get a portion of that, depending on obviously how much the percentage you invest, but it'll be split. It'll be split, just like we talked about. You'll get that 8% preferred return, then it's going to go up to that IRR hurdle, that internal rate of return hurdle, which may be 15%, 70%, 20. It could be anything in there. And then you have to know what that waterfall is, right? If it's 70-30, everything after 8%, then whatever we make when we exit, well, guess what? It's split 70-30. Okay. Or if there's a waterfall, it may say, okay, once the investor reaches 20% return, then it goes 50-50. So that's going to be for all of that capital, everything that's made on the exit as well.
Do you see any supply demand shifts as a result of commercial space occupancy and turnover due to COVID occurring? Or is this a more short-term phenomena?
Great question. And I wish I had all the answers around that completely. But, what I personally see, like office space, I would be really leery of right now for obvious reasons. I think there's people that have been very strict on not teleworking with employees forever. And then all of a sudden they're like, wow, this really works. Look how much capital I could save by not renting that building, or even not even owning the building, or having a smaller space, or those things. And so I do see things changing in a lot of real estate, such as that, or maybe those spaces being converted into multifamily, but ultimately people have to have a place to live. And it doesn't matter, what the market does. People have to have a place to live. Obviously they need jobs to be able to pay rent. And so that's something we have to be very focused on. What kind of jobs are in the area? And again, what kind of jobs do the tenants have?
Okay. And I'll do just two more questions. This question says, let's say that I have 100K and I want to invest it in a triplex or a duplex. My return is 15%. Why should I invest in syndication or crowdfunding?
Yeah, that's a great question, and I would say, how much time are you spending to buy that triplex or duplex or whatever? How much time are you spending? Are you managing it yourself? If you can do that, and you're not managing it, and it took you little to no time to find that property and to do any of those things, then why not? Okay, why not? But ultimately, most of those deals, you're going to have so much time invested. There's no way, even if you on paper you're getting a 15% return, you're not, just because of all the time invested.
And the send off question, if we are interested in being a passive investor, how can we get in contact with you?
Of course. So you can email me, Whitney at lifebridgecapital.com. Go to our contact page and sign up there. If you email me, I'm happy to connect with you and talk to any of you and help in any way I can. And you can also, don't forget, you text Whitney to 66866 and you'll get our guide to passive investing as well. But go to the website, lifebridgecapital.com, go to the contact us page. We'd love to connect with you. You'll get a call from us quickly from our team, and then you'll get to talk to me soon after. And also, I'll put out my phone number. You can call or text 540-585-4338. 540-585-4338. Look forward to speaking to you.
All right. Thank you very much, Whitney, for coming and sharing a bit about real estate syndication and letting us know how all the different structures work. So thank you very much for being here, and we'll close the meeting off now.
My pleasure, Daniel. Thank you very much. Honored to be here.